versus renting. This, of course, is about investors, which is the greatest client. If you don't know, if you're new to the game, there's nothing better than real estate investors. They're worse than CrossFit vegans, because whether they have one property or they have 16, they can't not shut up about it. And they love to tell everybody. And if you're programming them right, they're referring you, right? Investors are great. They're not emotional. It's all data and numbers driven. So get some investors. Here's a great way, great tactics to do it. I'll be back on later. Thanks you guys so much for coming. And I'll let Brady take it away.
Thanks, man. Yeah, it's kind of hard to follow that kind of energy, but real quick, well, let's just dive in. Before I do that, by the way, I'm going to be glancing over at, so whenever I look to my left, it's because I'm looking at all of your cute little faces. And the reason I have to do that is in order to provide CE. If you're on here and you need the CE, you got to have your camera on. If you don't need the CE, then you don't need to have your camera on. That doesn't bother me. I just have to comply with that because there are DORA people out there keeping people compliant, you and me both. So every time I'm looking over here, that's where I have your faces posted so I can look at my content while I'm talking about it. But if you want the CE, turn your camera on, pay attention, or look like you're paying attention, and that'll be enough for me. Okay, let's dive into the content. So as far as my background, oh, one more housekeeping thing, since I heard a noise. Here's what I'm going to do. I'm going to mute everybody. However, I'm going to leave it up to you to unmute yourself if something I said wasn't clear, or if you have something that you think would be useful for everybody else attending, just chime in and chat. If that becomes chaotic and that ends up not working because of background noise, I can always mute everybody and we can start from scratch, or I can make that permanent and we can use the chat. But you can also, you can also throw stuff in the chat. I'm also looking over here to try to keep up with that stuff as well. But that's the housekeeping stuff. Let's dive in. All right. So my background, I was a financial advisor for 18 years. And after about 15 years into that career, I started running analysis on real estate. There we go. On real estate. And I just had this epiphany that I needed to add that. I actually was investing in real estate, and I noticed that my best clients were also investing in real estate. And so I started running some charts and comparisons. We're going to talk about that. And I just wanted to add that to what I was adding to or helping my clients with. And I knew that was a tricky field for compliance. So I called them and I said, hey, this is what I want to do. How can I do this so that it's compliant? And they kind of chuckled and said, you can't do that. And I said, well, come on, work with me. What can we do? And they're good people. I knew them because we'd had conversations many times. It's a very compliance intensive industry. And but they were like, you really can't do that. And if you do, our relationship will terminate today or tomorrow, immediately. And the reason was, bottom line, the cynic in me is immediately well, it's because you don't get paid. It's all a money thing. That's greedy, blah, blah, blah. And, at the end of the day, there's probably some of that involved, but it gets caught up in this legal, this machinery where they just don't have any triggers in place to confirm whether something is suitable for a client. So in the financial field, they've got all these profiles for the clients. And when a trade is made or an investment is made, if it's, my grandmother who's 93 years old and she's putting her last $50,000 in an offshore oil drilling program, then that would raise a red flag. And they'd call me and say, hey, that's a mistake, or you're fired. Obviously, it would probably be more conversation than that, but they have triggers in place like that so that something doesn't accidentally slip through that wouldn't be suitable for the client, and they just have no way of monitoring that with real estate. So after a long battle back and forth of trying to make that work, I finally just gave up and sold my practice to some people that I knew and trusted in the industry, because these clients were very important and dear to me. And I left the industry to work in real estate for a couple of reasons. First, I felt like this message wasn't being told loud enough. I am not anti-market, pro-real estate. I think that people should be diversifying, and real estate should be a part of the financial planning process, and it just rarely is. And the other reason is that I've noticed, so I didn't meet a lot of broke people when I was a financial advisor, and I don't mean destitute. I just mean they don't come to a financial advisor unless they have assets. But I noticed one of the main decisions that people make in their lives that determine whether they have assets in the future or not is whether or not they own real estate. So I believe in the services that good financial advisors provide. However, they don't really help people until people have already done quite a bit of things for themselves, or at least gotten on that path. And I noticed that the decisions people make about real estate, where they live, whether they own it or rent it, is the first step. That makes the biggest difference in the trajectory of their wealth. So that's why I'm in this industry, super passionate about it, and I absolutely love it. And then I work with Kevin Green. Just a quick deal about our team here. I literally have 1 year of industry experience. I don't do loans. That's our team's job. My job is to provide content, to help market, to help share this message. And our team of 8 people do a really good job with a lot of volume. Just we're good at what we do, and I needed a team. So Kevin and I have known each other for a while, and I just needed a team that could scale. It wasn't a one-man shop where we had, if we needed to scale, we could add somebody in this position that already had a job description, so on and so forth. So that's my role on our team, and that's how we help people. So enough about us. I wanted to share a little bit about my background so that you see where this is coming from. Okay, I like to start because we're going to start talking about some numbers that are just frankly going to blow your mind. And so I like to start just simply by stretching our minds a little bit, to start thinking about things that come naturally to us and things that do not. For example, this number that we see here on the right of the screen is 1 trillion. And we talk about that number when we think of budgets, national deficits. We use the word trillion, we use the numbers trillion. I've heard the number quadrillion come up in a couple conversations in the last year or two when we talk about budgets, because they're huge, national budgets in the United States. But let's think about what a huge number 1 trillion is, because it's not something that our primitive brains evolved to understand. So a good way to associate the number 1 trillion with things that we do naturally understand is to think about a trillion in terms of seconds. How long is 1 trillion seconds ago? And I'm usually doing this live and interactively with people that are in person, right? We're three-dimensional. So I'll just kind of go through this stuff without asking for feedback. But a trillion seconds ago was 30,000 years, 32,000 years. So 30,000 BC is 1 trillion seconds ago. So that's before Homo erectus left the African savanna. That's a long, long time ago. Before writing, before language, at least written language, like just a very, very long time ago. So let's now stretch our minds with something a little bit more, let's say, just conceptual. So this is kind of a fun one. Look this up. You're not going to believe this because I didn't believe it, but look it up. It's absolutely stunning. So if you shuffle a deck of cards, there's a possibility of a certain order. Well, there's a certain number of possibilities of orders in a shuffled deck of cards. And the way that's calculated in statistics is the number 52 factorial, which is 52 times 51 times 50 all the way down. That number becomes 8.06 times 10 to the 67th. It's a 68-digit number. We don't have a word for that number. It's too big. Interestingly, that number is greater than 1.19 times 10 to the 57th, obviously. In fact, it's 10 digits longer, 10 orders of magnitude larger than this number. And this is the number that physicists estimate is the number of atoms in the solar system. There's more possibilities in a shuffled deck of cards than there are atoms in the solar system, including the star in the middle. This is based on the mass of the planets, their projected makeup of those planets, et cetera. And it's not only larger than that number, it's actually 68 billion times larger than that number. So a shuffled deck of cards, the possibilities are roughly the same as 68 billion solar systems that are identical to ours, atoms in those solar systems. Mind-boggling, look it up. It doesn't make any sense because we deal with cards regularly in our lives. Atoms in the solar system is incomprehensible, but the chances, that's why getting something like a royal flush in a game of poker is virtually impossible. Almost never happens without wilds or without, drawing 50 times. Let's see. I got a quick message. Somebody got booted out. Let me see if I don't have a waiting room in this room. Deanna, if you're chatting with Rich, if he just gets back in, there's no waiting room, so he should be able to get right back in. Okay, so what does that have to do with math and real estate? Not much, other than we're going to start talking about something that is similarly counterintuitive. We'll use that for a word. So Albert Einstein claimed that compounding interest is the eighth wonder of the world. And when you add leverage to that, it just gets even more crazy. We're going to talk about returns on real estate in a second. But before we do that, we're going to talk about returns in general, because this is something that we just don't do well in our heads. So if we compound $100,000 for 30 years, and by the way, when I say we don't do these well in our heads, I don't either. Like if you asked me, if you compounded $50,000 for 18 years at 7%, what would you have? I have no freaking clue. And I've been doing that for 20 years, but I still have to calculate it because it isn't something brains can do naturally. It's not a linear thing. It's a curving thing. But if you compound $100,000 for 30 years at 10%, that becomes about $2 million. So it becomes 20 times its value over 30 years at just 10%. So here's what's weird. What if we just raise that rate of return by 5%? Now, granted, it's 5% more compounding, but it's 50% more interest. So that's a clue that this number is going to be bigger than you think it is. But that number isn't 50% more than 2 million. That would be 3 million. That number is almost $9 million. $100,000 compounding at 15% a year for 30 years becomes almost $9 million. Get this, the difference between those two is $6.7 million, $6.8 million. This is what's crazy. So think about it. Here's a way to say this. The difference between earning 15% and earning 10% is 68 times the original value invested over 30 years, excuse me. So the difference of earning 5% more than 10, earning 15%, is 68 times the original investment. Here's a graph of those two things moving and compounding. So the green is 15%, the blue is 10%. And this is just how compounding equations work. They just get steep with every year that goes by. Here's one more mind-blowing idea. So there's that difference, $6.8 million at 30 years. There's the difference at 29 years. The difference at 29 years, it's kind of hard to read there, but it's $5.7 million. So if you just compound for 29 years, that's 57 times your original investment. But this is what's crazy. It's always those extra years at the end that matter. The difference between 29 and 30 years is $1 million on your $100,000. So think about it. Every year that you wait, if you have this, so we're going to talk about how 15% I think is pretty reasonable in real estate. We'll talk about that in a minute. But this is just the math, right? But if you could earn 15% with something instead of 10, which I think, by the way, in the financial planning world, I never quoted 10%, or I never gave that expectation to people. Now the market can do that. The stock market has done that many, many times over 20 and 30 year periods of time. In fact, it's pretty historically reliably doing that. If you reinvest dividends, if you're careful with your fees, 10 to 11% is pretty reasonable in the market. Now, frankly, people often aren't reasonable in the market. They tend to buy at the wrong times, or they tend to buy when everybody's buying because it's exciting, and they tend to sell when everything's down, which is the exact opposite of what they should do. But I'm giving 10%. I'm using 10% graciously because I never use that term or that number in the financial planning world, because most people, I just didn't want to set that expectation. And as people age, they tend to start putting more bonds in their portfolio, so they don't actually get the 30 years of stock performance anyway. But again, I'm erring on the side of investing in the stock market and that looking pretty good. But here, that $1 million in that last year, that's the cost of waiting a year. And in many cases, people would, in my office, they would say, well, I don't have 30 years. I'm 55 and I'm going to be retiring in 10 years. And I'd have to remind them, like, we got to plan our finances out till we're 100 or at least 95, not 65. Because retirement, although it's an interesting milestone, it isn't the end of when you're going to be caring about money. And so just because these equations start getting steeper and steeper, because that's what happens with compounding, every year that you wait is costing you more and more, because you don't get to jump in the game at this point. You have to start making a different rate of return on the money that you have. And this is just $100,000, which is pretty modest in terms of savings for retirement. Now, that might be a lot if you're 35, but if you're 55, you're kind of behind, right? This is not a huge amount for savings. But in the difference between the 29th and the 30th year is $1 million. And the difference between the 30 and the 31st year is going to be somewhere in the range of probably $1.4 million, $1.3 million, something like that. So the differences just get bigger at an increasing rate. Okay. Wow, right? That's pretty cool. Any comments, any thoughts on this? Anything that I'm missing? Anybody want any clarity on this? We'll move on. Okay. So now that we're talking about that, I want to just do one more plug reminder. If you need the CE, I need your camera on. And this, I want to stress on this just a little bit. So when I do courses, I imagine that there's a handful of people attending that know this kind of stuff. I don't think I'm the greatest. I'm not the only person that can build Excel spreadsheets and models and stuff like that. I think I'm pretty good at it, but I've seen people that are also really, really good at it. And I've had some help, frankly, from some friends. My brother's a CPA. A close friend of mine is a CFA. And, you know, I've had some help with making sure that the calculations are correct. But my point isn't that I'm going to show you something, or I'm going to prove to you that real estate investing is good. I hope you already know that. If you don't, hopefully some of this content will convince you. But what I want to focus on here is how are we telling the story to the people that need to hear it? Because ultimately that's why we're here. Even if it's content that we need to digest and get comfortable with ourselves, we still need to get to this point where we're talking about how do we help people see this message for what it is, because it's powerful. So be thinking in terms, you know, when I'm talking about this, in most cases, I don't think I'm showing you something that you don't know already, at least conceptually. Maybe I've put some figures to it that you haven't seen before, but it's about the language. How are we helping people bridge the gap between what they understand about real estate investing if they're not doing it, and what real estate investing is really like, and helping them bridge that gap so that they ultimately make that choice. And I'm always clear about asking for feedback. I'll have a follow-up email with some content. I have the slides, those will be coming, and a couple other things, but please reply with feedback. I'm really interested, not just yes or no. I mean, that's helpful if you're like, I loved it, or, you know, it wasn't so hot for me, but details about what I could do to make it better. Because I build this content because, you know, I'm constantly honing it in based on what we think is effective for both you and prospects that would be seeing it. Okay. So let's dive into what the people that we're talking to. So when we're talking to prospects, they also are being marketed to and spoken to by financial advisors. And I want us to kind of understand the financial advice world so that we know what they're hearing when they're being spoken to about investing. And this is from the good financial advisors like me, or like I was. All right, I'm just going to pretend that my jokes were funny because I can't hear anybody laughing. So and your faces are over here. And my background's in math-related stuff, and I have a bunch of kids, and I go shopping at Costco. My sense of humor is terrible, so just bear with me. So the way that I started, you know, when you start out in a financial planning career, there's a lot of training that you go through, and then you start seeing patterns on how different messages relate to people. And I was very careful to be. I mean, I always felt like I was helping a sibling or a parent. I wanted to do what was best for them. And so I started thinking of how to relate messages to them about investing that would make sense. For example, to my mother. My parents have traditional roles in their marriage where my dad takes care of the finances. I have 5 siblings, so my mom was very busy, worked her butt off, but it was in the home. So I always wanted to make financial concepts understandable to her, because I knew that if they were understandable to her, they were understandable to everybody. And so I broke down, I call these my priority list. So if you came into $100,000 and you didn't know what to do with it, so you called a financial advisor. Now imagine you're not in real estate, because if you came across $100,000, you should also be talking about real estate opportunities, but we'll get there in a second. But just imagine somebody that's, you know, an HR professional or something, has nothing to do with real estate, has nothing to do with finance. They inherit $100,000. They call the financial advisor. And if the financial advisor is good, when that person asks, what should I do with that money? The financial advisor should say, that depends. We need to have a meeting about that, because I don't know your family dynamics. I don't know if you're trying to, you might be terminally ill for all I know. That would make a massive difference in what we would do with that money. Are you trying to save for kids' college? What's your age? Are you married? Do you share finances with your spouse? Blah, 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 blah. So I broke that down into what is it that you need this money to do, and what can you sacrifice? Because every investment category has strengths and weaknesses. For example, We'll just look at stocks real quick, and I won't go through every category for every or for every priority for every category, but just so that we see how this works. Stocks, is there upside potential in stocks? Yes, there is. Stocks can make decent money. Are stocks stable? No, they're not. They are traditionally and historically quite volatile. Are stocks liquid? For the most part, if you're dealing with public stocks, you can buy them and sell them with the click of a mouse, turn them into cash right away, very liquid and very, very inexpensive to do so. Can you leverage stocks? Yes, you can, through things like margin, through options. You can get very levered in stocks. It's very risky, but you can use leverage if that's important to you. I think of these top three as the most important. These are the things that most people, what's the upside potential? How reliable is it on a day-to-day basis? And how quickly could I turn it into cash if I needed to do that? These are more ancillary ones, the bottom ones down here. But if somebody wants to use leverage, that could be important. If somebody wants it to produce income, stocks can do that. The upside for stocks is that the income that you create from like a diversified portfolio of stocks that's paying dividends is historically those dividends go up. So it's a good hedge for inflation, but it's not a very high income that you get out of stocks that pay dividends. Traditionally, stocks are a decent hedge for inflation. They're not a perfect hedge because they are not real assets, but they have outpaced inflation historically, given you hold them long enough. And they can be very tax efficient if you do it right, because you can hold on to them and never pay taxes. You can even pass them on to heirs and get a step up in basis like real estate. Most people don't do that, but if your intention is tax efficiency, you can set up portfolios to do that. And then do I have any risk protection in stocks? And traditionally the answer is no. And if there's any stock buffs out there, you can set up you can sort of duplicate this, or you can create some sort of makeshift insurance by trading options the right way, but that's so rare as far as percentage of people that are investing in the market that I just consider stocks not really an insurable asset. You get what you get. Okay, so that's how that works. Now, bonds have a place. They've got weaknesses, they've got strengths. And then there's cash. Cash is important, right? Because it's very stable, it's very liquid, and we know it's not going anywhere. But it's very bad for leverage, pays no income to speak of. It's not a good hedge for inflation. It's traditionally awful for inflation. It's tax inefficient, and there's no upside potential. So I value cash. Cash is important. Everybody needs cash, but it's for short-term needs, right? Then there's like insurance products, or these derivatives of insurance products, or the annuities or permanent life insurance, like whole life insurance or equity index life insurance. Those have a place. They're often oversold, but they do have a place that makes sense in certain scenarios. And again, I won't go into the details of all these. You don't need to be financial planners, but that's the toolbox, more or less. I mean, there's nuances in here, and I don't have, we could talk for days about all the nuances in here, but for the purposes of today's discussion, this is the toolbox of financial advisors. You've got stocks, bonds, cash, and some insurance products to help with. And there's one massive asset category that everybody knows exists. Everybody knows wealthy people invest in it, and yet financial advisors aren't talking about it. And that just rubbed me the wrong way for long enough where I was like, okay, I got to get out. Not because I hated it, but because I wanted to help people see where this fits with all these other things. So real estate, now granted, it's not perfect, right? It's not perfectly stable. It can go up and down. It is more stable than stocks, but less stable than like cash or insurance products. And as far as the others go, it's about as illiquid as you get. Now, it doesn't mean you can't sell it, but it takes time and there's costs. You don't day trade real estate. So other than that, and maybe, it's not insurable in the sense that cash and annuities. That's why this is half, by the way. I can insure the property, but I can't insure the outcome of my investment like you can with annuities and cash. The value of these are going to stay the same. That's why these get these full marks. In real estate, you can insure the asset, but not the outcome. So of all the asset classes, it has the best profile as far as the quantity of attributes or quantity of benefits. But it doesn't mean that everybody's entire net worth should be invested in real estate all the time. These things have places, but this should definitely not be ignored. And then there's one more category that I don't even mention. It doesn't even enter the scene when you're talking to a financial advisor, but it does when you add real estate, which is, I call it the inside knowledge advantage. If you're a CEO of a company, or if you're a political figure or a military leader of sufficient rank, there are certain things that you can't buy or sell in stocks and bonds because you have influence in how those things perform. So it's illegal to do that. Now, when people do, and get caught, it makes the news. But that's a big no-no. You're taking advantage of things. You're manipulating markets in a way that's unfair. So we have laws around that. There isn't really a way to do that with cash and annuities, so those don't get any marks either. But with real estate, if you know something about a particular transaction or property or seller or buyer, you can use that. It doesn't have to be public information for you to use that to your advantage. I'm not suggesting we take advantage of people that are in a bind, but if somebody needs to sell quick and so they put it on the market for low and it needs some fix up and they're giving some value away because they need the value they need is speed, that's not taking advantage of them. That's just good business. That's the way that it's done. Any thoughts? So oftentimes when I'm live and I'm getting more engagement, I get a comment that is similar to like I'm not really teaching you or showing you something that you didn't already know. It's just never been condensed and presented in this way, but it's very helpful to see everything there for what it is. If hopefully it's had something like that kind of effect. But any thoughts or any questions before I move on to the next stuff? Are we good? Give me a quick, I guess, thumbs up, or throw me something if we're on the right track, or if I'm boring you to death. All right, I'm looking at everybody giving me thumbs up. Okay, we good? Is this stuff your clients need to hear? The answer, I think, is yes, right? People need to hear this. So I also noticed, and I'll throw this out there too, that this message, sometimes I show some of my content or some of the calculators that I've built to people, and they'll say, "Oh, I have the perfect person you need to talk to. They've been investing in real estate and they're doing really well. They'll really like this." And I do like sharing that with people. I do like talking about investing in real estate with people. But what I've noticed is the people that need to hear this are the people who have, $600,000 or $700,000 in their retirement savings, and they've been diligent about that. They've been saving since they were young, and all of a sudden, the stock market crashes, and they're reminded that that's not invincible, and the bond market crashes at the same time, and they were told their whole lives that doesn't happen at the same time, but it does. And this isn't the first time, by the way, and they don't want to put their money in cash because they're seeing that erode very quickly with inflation, and they're hesitant about annuities because of the cost of those things, or about life insurance. And again, not that any of those things don't have a place, but they're not being told that this is an option. And this message that we're talking about today really resounds with people who either have invested in real estate, like dip their toe in the water, or they're kind of looking at it being like, maybe I should do that. Maybe I should add some value to my savings by diversifying outside of the traditional things. This has been really powerful with that group of people. I forgot about my little animation there. So not only does it have, it's the only one in these categories that has upside potential similar to stocks, but also, I think, reliably speaking, now stocks, granted, if you got some stock options when you were one of the first 10 employees of Google or something like that, then you're a billionaire or something like that. But reliably, for average Americans doing their jobs, saving for the future, the returns on real estate are probably better than they think. So we'll talk about that. We're going to get into that pretty heavily.
Hey, Brady.
Okay. Yes.
Any way we can get that last panel? Just that panel?
I'm going to be sending the slides out to everybody that attended.
There we go. Never mind.
Does that work for you? Okay.
That works.
And it'll be in there.
Thanks.
Yep. Thanks, Rich. Okay.
Yep.
So here's this is a story, and the reason I tell this story is because I think it encapsulates all of the common misunderstandings that people have when they think about real estate with their intuitions, and they don't stop to check those intuitions with logic and math. Okay. So this was a conversation I had with a Pilates instructor. I was in a Pilates session with her, and after 20 or 30 minutes of whatever instruction and stuff, we started to just chat, as people are wont to do. And she asked me what I do for a living, and I said, well, I help people invest in real estate. And she said, oh, my husband and I had real estate, and we didn't really make any money. It was kind of a bad experience for us. And of course, that can happen, right? It's not bulletproof. And so my next question, I didn't say, that's bull crap. I said, tell me what happened. How did that go? That can happen. What's going on? Now, I suspected that she was probably making some mistakes, but I didn't know that yet. And so I asked her that. I said, tell me about that. And then she told me this story. And the reason I'm saying this isn't because I'm not going to blow your mind with anything here. What I'm going to do is tell you a story that you've probably heard either bits and pieces or the entire exact conversation with people you've had conversations with. But here's how this broke down. She said, okay, so we purchased this 3-2 townhome in the Seattle area for $200,000. And within a month or two, my husband got an offer in Denver that we couldn't refuse. It was a great career move for him. So we moved to Denver and we decided to keep the house. Now, interestingly, in this story, this was an accident for them because they used an FHA loan. They put 3.5% down and they couldn't sell it without bringing money to the table because they'd only owned it for a couple of months. The cost of getting rid of it would have been more than their equity. And so they're like, well, I guess we're real estate investors now. So they did this by accident. And then she told me she didn't make any money and sold it 10 years later for 400 grand. So let's go back to this one. She said, I didn't make any money. And because I've heard this enough times, I said, well, tell me about that. What happened? And she said, well, we'd cash flow some months, but every third or fourth month, we'd have this $1,500 expense or whatever. And it just felt like it was taking all that away. And first of all, just for all of us listening here, for best practices, so I asked her about that. Do you know that you didn't make any money or did it just feel that way? Because often our emotions and what's going on with money are not at all the same. So I asked her, do you know that you didn't cash flow over that period of time or was that just how it felt? And she said, well, to be honest, we don't really know because we were taking the rent money, putting it in our joint checking account, the same account that we used to buy groceries. And when we had expenses, we would take that and put that we would use money from our joint checking account to fix the water heater or to replace the carpet or whatever it was, which is not unethical. There's nothing wrong with doing that as far as, you're not hurting anybody other than it's just a terrible business practice because you don't know and you need to know. So you should be keeping an extra set of books on every property you have. But anyway, so I suspected when she said she didn't make any money. Now, because I knew it was in the Seattle area and I knew about the time frame that she bought, I was like, I'm really skeptical that you didn't make any money. So I started in the back of my mind. I was like, okay, I think you're probably wrong about that. So I said, well, what about when you sold it? What happened then? And she goes, oh yeah, when we sold it, yeah, we sold it for $400,000. Now, isn't that stinking amazing that I said, I help people invest in real estate. Her immediate reaction was like, oh, we had a really bad experience with that. And we didn't make any money. And all it took was 1 or 2 questions. And she was like excited about, yeah, that was different. Like when we sold it, man, we were so tired of owning that. When we sold it, we put a bunch of money in our pockets. So I asked her how much she made, and they walked away with about $250,000 after expenses. So that was the check that went into their bank, 250 grand. So that was her first mistake, right? This one right here. I didn't make any money. Well, let's talk about that. Did you? Okay, yeah, I guess I did make some money. What's weird is that people don't. I shouldn't say weird. I guess it is weird, but it's weird that it's so common that if I were to ask her, she's not a dumb individual. If I were to ask her, like, do you realize that's the same investment, that investment that you didn't make any money on because you didn't cash flow well? Or so you think, because she didn't really know. But let's say that she's right about that and she didn't make any money cash flow. It was everything that she made was gone with the mortgage and expenses. Even if that was true, it was weird that she didn't connect those two. It's weird, but it's also super common. But your investment experience is like real estate is both of those things, of course. We know that, but people don't make that connection without being reminded to make it. So the next mistake that she made was, well, I guess I doubled my money because I bought it for 200, sold it for 400. I doubled my money. And I was like, okay, you probably did better than that. Tell me a little bit more. And by then, at that point, I didn't know what she paid for it, like her out of pocket. I didn't know about her FHA loan, but she goes, well, we used an FHA loan. So we put 3.5% down, which would have been $7,000 on a $200,000 purchase. And I'm throwing in some closing costs. So they probably spent around $10,000. I said, is that reasonable? She goes, yeah, that's probably right. So here's what happened. Again, I'm going to believe that she was cash flow neutral, although over 10 years, I suspect that that's probably not the case, but let's assume that it was. She walked away with $250,000. Now, as a financial, with an investment background, I have what I need. I have the previous value, or the present value, depending on what you want to call it and how you're doing the calculation. But I've got the value at the beginning, I've got the value at the end, and I have the time frame in which it happened. And with those three elements, I can compute an annualized rate of return to turn $10,000 into $250,000 in 10 years is a 33% annualized rate of return. Like, that's crazy. Remember the difference between 10% and 15%? She didn't double her money. She 25 times her money in 10 years. Now, granted, okay, so this is a little bit of a cherry-picked scenario because it's not scalable or it's not iterable, right? You can't do that with FHA loans over and over and over again. You can't scale quickly with FHA loans that way because you can't use them to purchase investment real estate. But that kind of rate of return is like, Warren Buffett would be jealous of that rate of return. Now he has a different kind of problem. He's a great investor, but he has to scale in terms of billions, and she was doing it with an FHA loan, so on and so forth. But like that's an incredible rate of return because small differences make big changes on the amount of money, and that's a huge difference. 33% rate of return. So what was unusual about this? It's a little unusual because she used an FHA loan for investing on accident, but it happened. But was the appreciation unusual? So of property in the Seattle metro area going from a value of $200,000 to $400,000, that's a different number because so it is compounding like the rate of return that we were looking at earlier, but it's just the value of the property. It's not what's happening with her wealth, because her wealth is the value of the property and the investment, and then the loan, the leverage changes everything, and the cash flow changes everything. But the appreciation of that property just standalone, had you bought it cash and never rented it to anybody, your rate of return on that property would have been 7% annual, which is not unusual in metropolitan areas at all. It's on the high end of average, but it's not like knocking it out of the park. It's pretty regular. Okay, I'm going to glance over here. I saw something pop up in the chat. Let's see, before we finish. Okay. Yeah, I'm going to get to that. Okay. So then the last question is, what should Jill do with the proceeds? And she didn't do this because she was just glad to get out of that bad experience where she wasn't making any money. But it's hard to believe that, I know what I was paying her, and maybe she had money elsewhere. She was young. She was like, I want to say like 35. Well, I feel old when I say that somebody at 35 was young, but like putting $250,000 in your back pocket when I'm guessing she was making $25 an hour after expenses, because she was working out of a chiropractic office and I was paying like $45 for the session or something like that. So whatever, I like putting $250,000 in your back pocket on accident. That would have been hard to do in any other way that I can imagine without taking a massive amount of risk. So here's something to think about. So is that a common, now you may not have that end-to-end conversation with somebody the way that happened for me, but are pieces of that, do those echo in the conversations that you have? Like I'm looking over, like, does that happen in conversations that you have where people just have these weird misunderstandings about the way it works, and it's usually way better than they think? Anyway, okay, so let's dive in, and this is just my anecdotal after years of thinking about this and trying to figure out why that is. I came up with at least one theory that I've noticed is reliable enough to use, which is, I think one of the things that the financial industry has done very well is they've made it easy to understand. There's a lot of moving parts in that industry. That's true, but they make it simple. So imagine somebody, again, who isn't in real estate or finance, and they inherit $100,000. And let's say that this person goes into a financial advisor's office and the advisor says, okay, are you married? Do you have kids? When do you want to retire? What else do you have already? Do you have a 401k? What's your savings rate there? All the right questions that financial advisors should ask. And then they get to the bottom of it, and the financial advisor presents something that is really nice and shiny. It's on glossy, thick paper. It's got the client's name printed on it. It looks really, really nice. And it's got pictures of people smiling. It's got an old couple. One's holding a surfboard, and the other one has some I don't know, flowers or something. I don't know, some nice picture. Like that material is plastered with that stuff. But at the end of the day, the math part of it is very simple. It's an XY graph where you've got a beginning point, an end point, and a current value and a future value. And it's real simple, right? So we've got $100,000 15 years later. Now I just pulled this image off of Morningstar, and this is the Growth Fund of America. So it's a $100+ billion fund, very popular fund. And from 2007 for 15 years, it turned 100 grand into 437 if you didn't sell at the wrong times and buy at the wrong times. But then we can use that, like I did earlier with the beginning value, the end value, and the time in between. We can use that to calculate annualized rate of return. So when I show this to the client as a financial advisor, this is easy to understand. And the number that they focus on isn't this one. I mean, they may, that might ring, in their memory when they're thinking about this experience, but this is the number they're looking at, right? They're looking at, wow, I could have $437 or $1,000 if I just leave this alone and just go back to work and keep saving, blah, 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 blah. And this isn't including any savings. This is just putting it in. I mistakenly said savings there. That's just what it turns into at that rate of return, or that's what it did over the past 15 years. I made this slide last year, but that's what it did. Okay. And if this person is smart enough, well, before I go into that, if this person is smart enough to say, hey, Mr. Financial Advisor, before I commit to this, I want to, I've got a friend in real estate. I want to go ask them how this would work. Now you can see the storm clouds come in, the financial advisor. Oh yeah, well, good. You're going to be changing toilets. You're going to be dealing with evictions. You're going to have, somebody's going to build a meth lab in your basement. You really don't want that. But this person is convinced. They're like, I want to sleep on it. I want to go talk to him if they know to do that. And if we walk into a real estate office, then most of the time, now other real estate offices are some are better at this than others, but at the end of the day, one of the problems we have in this industry is real estate is just a slightly more complicated asset, right? If somebody walks into the office, they inherited $100,000 and they're thinking about investing in real estate, we've got this conversation about, okay, well, that's going to be a down payment. You're not going to buy anything in Colorado for $100,000, at least where people live. But that's going to be a down payment. So there's going to be this mortgage. That's kind of scary because now the numbers are getting pretty big, pretty quick. And so there's going to be this mortgage, then there's going to be these expenses, you're going to be this revenue, and then we'll have to look at properties because they all behave a little bit differently. And if we find a good one with maybe a 5% cap or a 6% cap or something like that, you're going to cash flow $38 a month or minus $38 a month or something unexciting, right? So it's instead of them focusing on this number, because this is just a beginning and an end thing in the financial advisor's office, they're focusing on that unimpressive number, which is the cash flow. And $38 a month, even if it's positive, doesn't always have to be positive for it to be a good investment, by the way. But that's sometimes a benchmark for people. But let's say it's $38 a month or $138 a month. If you invest 100 grand and you find a property that's doing that, and it's at maybe 25% down payment or something, that's probably not bad in the Colorado area, but it's not exciting for them to look at. And so these are what the financial reports look like in the real estate industry. And this is just confusing to people. Like, this is what they're seeing in a financial advisor's office. This is what they're seeing in real estate offices. And so we have that challenge. Now, on the flip side, we have something they don't have, which is something awesome to look at. Right? We can go through homes with them and show them to them. Or if they're looking at buying a short-term rental, they can go look at it. They can go stay there. Right? We have something that's more fun for them to buy. But we have to get over this part of it. We have to express as best we can. We have to express these numbers in terms of, here's what you have now, here's what you'll have in the future, and then tie that to emotional anchors for them. Because when they see this, they simply just don't know what to do. Like, they're drinking from a fire hose when they start looking at numbers like this. I think of these conversations sort of like a wagon wheel, where I talk about different sections that are all centered around real estate investing, but it's not like a linear conversation where I'm building one thing upon the other. So I'm about to move on to the next section. Do we have any questions before I do that? Okay. Okay, somebody asked about, I think we got that cleared up. Are we all good? There was some stuff in there about Okay. All right, let's talk about this now. This is one of the things that I think has more impact than people give it credit for. People focus on cash flow because it's an easy thing to see, and it's an exciting thing to see, especially because if you're cash flowing positive, that feels like, you know, that's kind of sexy because it's passive income. But if you look at where the returns come from in real estate, your returns, what causes your money to do what it does, to become larger, for the investment to grow, most of that is due to the equity growth. I'm not saying that cash flow isn't important. It clearly is important, but it's where the returns come from are more heavily weighted toward the equity. And here's why. So I've simplified this a little bit just to ignore some of the minutia, but the concept here, I mean, in minutia, things like, you know, closing costs and things like that. Now that's not nothing, but just the concept here is what I'm after. If you buy a $500,000 asset with $100,000 down, 20%. So this green represents the debt, this represents your equity, and this is the total value of the property. If that asset appreciates by 5%, that is now a $525,000 asset in 1 year. I mean, this is a 1 year time frame. The debt gets paid down to $394 in that same time frame. It's not very exciting, but it's something, and it's a compounding thing. Like every payment is more and more principal at an increasing rate because that line is curved as we pay the mortgage off. So it's very small in the beginning, but it's something. So you turned $100,000 into $25,000 of equity because of growth, about $6,000 of equity because of debt pay down. So you turned $100,000 into $131,000 in 1 year. That's a 31% rate of return on your asset, and there's no cash flow, and the asset appreciated by 5%. And I know we can all think of scenarios where assets appreciated a lot more than 5% recently. But I mean, that's great when that happens, but I don't want to need that to happen for the investment to do well. Is earning 31% on your investment in the first year, is that substantial? It is. It's massive. If that asset appreciates by 20 or by 5% again, now it's worth $551,000. It's not another 25 because this is a compounding thing. So now we've got $163,000 of equity. So we turned 100 grand into 163 grand in just 2 years with no cash flow and with only 5% appreciation. So we got wealthier in the first year by 31,000. We got wealthier in the second year by 32,500. In the third year, it happens again. We get wealthier that year by, like, we're getting wealthier at an incrementally larger rate or larger amount. So after 3 years in this scenario, and every scenario is different, but in this scenario, you doubled your investment in 3 years. You went from 100 to just under 200, and the asset only appreciated at 5%, and we haven't talked about cash flow yet. If this is cash flow neutral, you doubled your money in 3 years. Any extra cash flow will put some cash in your pocket, of course, but that's with no cash flow. Now let's think about this, because now that we're talking about 20% down or 25% down in some scenarios, that's something you can scale. You can't scale the FHA because the reason they were able to, this addresses that earlier thought. The reason they were able to invest in FHA or with an FHA loan is because they fully intended to live there. It was a residence they were purchasing. Their situation changed and they didn't refinance. But anyway, so now we're talking about something that is scalable. So if you use 20% down to get into a property, we've just seen, I'm taking the numbers out because this slide's going to get pretty busy, but this is what just happened in 3 years. So this is T equals 0. In 3 years, we've doubled our investment. These aren't to scale. That's probably a little bit bigger than double, but are you allowed to do this with your equity? Use some of it to take it out and go buy a boat. Yes. You could buy the dream car that you always wanted. Or if one real estate piece isn't enough and you want to buy another one, you can buy another one. Now that's called refinancing, right? You're taking the equity out. In some cases, you have to refinance the first lien in order to do that. But we'll talk about rates in a minute. Rates, I'll use this analogy and then we'll get more into rates. But rates are, to me, they're kind of like gasoline. There's really nothing I can do about the price of gasoline, and it's so valuable to me that I'm going to pay whatever they ask until it's $15 a gallon. I'm going to pull up to the pump and I'm going to fill my truck when I need to, because I just need to get around. It doesn't really, it matters, but it's not going to change my activity no matter what it costs. unless something drastic happens. And interest rates are the same way. If I had this investment property and this loan's at 4% or so, and loans right now are at, I don't know, 6.5 or something. If I refinance that one for a 6.5, granted, I don't want to do that just for the sake. I wouldn't refinance this and just replace the loan. But if I'm taking cash out to go and get 15, 20, 25% on another property, what the hell do I care if it's 4 or 6%? It's the price of gasoline. It's so valuable. I'm going to do it and buy another property. So now I've got both those properties doing that. Now I'm doubling that investment again, because I'm going to jump back at this because this is important. But if this is a lot for you to, like, if you feel like you're drinking from a fire hose, take a break and get a drink, because this is a little bit deeper than that. But I want to understand it for those of you who are like digging into this stuff. Take a look. When I turn $100,000 into $131,000 over 1 year, that's easy math. That's a 31% annualized rate of return. When I turn 131,000 into 163,000 in the second year, granted, I made more money. I built more wealth than I did the previous year, but 32,500 is a smaller percentage of my equity at the beginning of the year than 31,000 is of that number of 100,000. So this is exactly 30.902%. So we'll call it 31% of this number, but this is something like 28% or 27% of this number. So every year in which this ratio between my equity and the debt grows larger in favor of the equity, every time it moves in that direction, the return on my equity the following year, even though it is going to be a larger number if I have the same appreciation, it's going to be a larger number than the year before, but it's a smaller percentage of the equity that I had the year before. So the way you can combat this, like granted, getting more money, there's nothing wrong with that. But if you're trying to keep your rate of return higher, if you're still in growth mode with your real estate portfolio, you do that. You re-lever. I'm not a fan of like 98% leverage or 100% leverage like we saw in, up to 2008. That's super risky, because if you're 100% levered and the market drops by 5%, you're upside down immediately. But 20% is reasonable. And taking 20 or 25%, depending on how conservative you are, or if you're really conservative, or if your client is really conservative, do 30 or 40% down. There's nothing wrong with that. But leverage plays a huge role in what the actual returns are. So now we have two properties doing that same thing. And now we're 6 years into it. And we've taken that $100,000 of equity, assuming no cash flow, and we've turned it into $400,000 of equity in a pretty short period of time with only 5% growth. And do you have to stop there? Like, does the government say, sorry, you can't own more than 2 rentals? Of course not. You can do that as long as you want. There are no rules against that. I mean, there are regulations where once you get to a certain level, you have to get, portfolio loans or whatever, but that's a ways down the road. This is like, I think of it like cell division, right? Every time you reach a point where you've got enough equity in one property turns into 2 turns into 4 to 8 to 16, you don't have to stop doing this. Now let's think about, so now I'm going to get back to something that we alluded to earlier, which was, how do we express this in terms that are simple for people to understand who are used to getting financial information from financial advisors? So if we look at what's happening here, that green is just the debt. That doesn't represent our wealth. The blue represents our wealth. Now, if you remember, when I added these two to the mix, I did it off to the side, but what happened was those were growing at the same time as this. I just ran out of space. So what really happened was, this is that cell division I'm talking about. 1 turned into 2, turned into 4. Now, if we all we have to do is just pile it up in a way that it doesn't like they don't. That's understandable when you explain it, but this is what they're seeing in their financial advisor's office. Boy, look at that equity. Then I had it split. Now I have 2 houses. Now I have 4. Now I have 8, whatever it takes. Like, this is my wealth growing. How much wealth do I have in year 1, in year 5, in year 10? How much wealth has my $100,000 turned into? That's what I'm after. Any thoughts, questions? I'm going to glance over here. As real estate, when your clients ask how much equity they should take out. Okay, that's public. Everybody can see that. Juliana asked a question. What do you advise they take out? I don't have a broad brush answer for that. And I don't refer them back to their financial advisor. Of course, I think that's a bad idea asterisk. Almost everything I say has a little qualifier to it, because there are some financial advisors that are real estate friendly that are phenomenal. By the way, they're the best ones, not only, I mean, for more than the obvious reasons, but also wealthy people own real estate. And if you're a financial advisor and you want to deal with real estate, you need to come to terms with the fact that your clients are going to be investing in real estate anyways, and help them in a way that satisfies the compliance department. So they can add that to the planning. They can show, okay, 10 years from now, given these assumptions about your real estate and about your other stuff, here's what we're expecting to be. This is what income you could afford to live on if you didn't have to work, whatever. But they can't advise them specifically on real estate investments. They won't do that. They shouldn't do that. So unless I know that they're working with that kind of advisor, because that's rare, I'm skeptical and I'm hesitant to refer them back to a financial advisor. But I start the conversation about risk, right? If you want to make sure that if the market corrects and turns at the worst time for you, which would be like in the first couple of years of your ownership of that property or of the refinance, if you re-levered, then 20-25% down. If the market fell by 25% in Colorado, that would be an anomaly. That would be the first time that's happened in our lifetimes by that amount, as far as I know. I know that in the 80s there was a correction, but I don't think it was that big. So 20% equity is pretty safe if people still want to get. Another part of the risk conversation is also cash flow, right? The less you put down, the larger your mortgage payment is going to be, and the less likely it is that you're going to cash flow immediately right out of the gate with a very large mortgage and a small down payment. So sometimes it's people just like, hey, I just want to make sure that I don't have to feed this investment every month if it's a negative cash flow. So sometimes the conversation goes there where we just back into the number. How much do we need to put down to make sure that the cash flow is neutral or positive? So it could be that kind of conversation as well. So everybody's different. Hopefully that addressed that, and probably and then some. I get kind of verbose in these. So yeah, if we can make it look like the kind of graph they're used to looking at, I think we're a couple of important steps in the right way, in the right direction. Okay, next piece of the wagon wheel. This is one that tends to get me on tangents, and people tend to have a lot of questions about it. I actually have a 2-hour CE course about this specifically because there's a lot of nuance, and I don't want to get into that today for the sake of time. But here is something that is a conversation starter. This will get people's attention. Remember what I said earlier about the stock market crashing, the bond market crashing at the same time, which is something that people have been told won't happen, but it does. And then they don't want to hold their money in cash. People are so freaking worried about their retirement accounts right now, justifiably so, for lots of reasons. Think about it. If you start saving, you're responsible, you do it right, you start saving 15 or 20% of your paycheck into a 401k or something like that when you're 25 years old. And if the market, by the time you've got $20,000 in there and the market corrects by 40%, you're down to 12 grand. Yeah, that kind of stinks, but 20 grand down to 12 grand, you don't really see your life changing, and you're 29 years old at the time or something like that. It doesn't really affect you. Let's say now you're 50 years old, 55 years old, and you got $1 million in your retirement accounts. You've done well for yourself, and that corrects by 40%. You're talking about a $400,000 loss. That stings for two reasons. A, it's a big number, like $8,000 over my lifetime. If I'm 29 years old looking at that happen to my $20,000 retirement account, that just doesn't really affect me. I don't think about that as a lifestyle change. When I'm 55 years old and I see a $400,000 loss, and that's the same market that produced that, right? A 40% loss. I see a $400,000 loss in my portfolio and I get nervous really quick because it's a bigger number and because my retirement now is something that I can imagine happening. I can see the finish line for where I'm sitting, and it just got really far away when that happened. And I feel like I'm totally out of control. The places that I would look to for like a safe haven from that happening, like the bond market or cash, those make me equally nervous. And nobody's telling me that I can buy real estate with my IRA. You can own real estate inside your IRA. It is an investment that your IRA owns, just like it owns a money market, just like it owns a mutual fund, just like it owns an ETF or a stock or a bond fund, which would also be a mutual fund. But like, it can own those things, but nobody's out there talking about it. And if you mention that, you don't have to be an expert in this. You just need to know who to bring to the table, because at the end of the day, if you're a real estate agent and somebody's doing this with their IRA, your job is basically the same. I mean, you should know that it's happening because the IRA is going to be on title. But the people the people helping, like the custodian for the IRA, the title company needs to know about this. Your insurance agent should know about this, not yours, but the clients, to make sure that that the insurance company knows that, so they can't back out of a claim if they said, oh, we didn't know that retirement account. I'm not predicting that happening, but I've heard stories. I've never seen it happen personally, but either way, you don't need to be an expert in this, because at the end of the day, you're just doing the same job you would do as a real estate agent anyway, which is find a property and help them, run some investment scenarios. But if you talk about this at a dinner party, you'll get people's attention. I guarantee it. 90% of them have never even heard of this. And the people that have heard of it ask their financial advisor about it. And the financial advisor said, oh, you don't want to do that. The IRS requires certain things from you, and you can't even do that with your Fidelity account. Yeah, don't bother. Right. So 90% of the people haven't heard about it. Of the 10% that are left, 80% of them don't know how to do it, or they've been scared away from it. 1% that's left are like, I know a little bit about it. I've never really taken the plunge, but I'm curious about it. And then 1% of them are going to be like, yeah, I do that all the time. And I have 2 properties in my Roth IRA, and I'm never going to pay a dime of taxes and capital gains or on the income that it produces. Like it happens all over the place. It's not a loophole. The tax code that defines what you can and can't buy in a retirement account is a list of 3 things that you cannot buy. It's not a list of what you can, it's a list of 3 things you cannot buy, which is they're collectibles. So you can't have a Corvette collection owned by your Roth IRA, life insurance, and S Corp shares. So if you want to own stocks, it has to be C Corp shares. Other than that, any legitimate investment is fair game. Now there's some nuance to this. You can't buy a vacation home that you stay in. You can't lease it out to your mother, or rent it out to your mother or your son while they're going to college. You can't do that with your retirement account. It has to solely be for the benefit of the retirement account. And I go into those nuances in the other CE, but this is a massively popular topic for people. It always has been, and it's been particularly popular because lately people are like, I'm worried about stocks, I'm worried about bonds, and I'm worried about cash. And that's the only thing that I think I have options. I didn't say that the right way. Those are the only options I think I have for my retirement account. So this gets people's attention, and you don't need to know how to do it. You don't need to know everything the IRS expects. You just need to know who to connect them with so that they can do that, and then you just do your job. And so the way it works really quickly is the property is titled in the name of the retirement account. So the retirement account owns it. There's no distribution required. So that's a common question. When we're talking to the 90% that are like, what? You can do that? One of the first questions they'll ask is like, hang on, do you mean taking the money out of my 401k, paying the taxes, maybe a penalty if I'm under 59 and a half, and then using what's left over to go buy real estate? And the answer is, you can do that. That's not unethical, but there are taxes, there are penalties, but you could do that, but that's not what I'm talking about. Your IRA can own the property like it owns other investments. And the tenants pay rent to the IRA or the 401k, or I'm using IRA as sort of this catch-all. So the retirement account owns the property. It pays the expenses when there are expenses due. It collects the revenue from the tenants, and you can borrow. You can borrow money. You can lever that account as well. You can get a loan on the house, or technically speaking, the IRA or the retirement account gets the loan. So that happens all the time. Now, one quick thing, I sometimes forget this. So this is more of a reminder to me than it is to you. Sometimes people who invest in real estate and who have other assets aside, they'll think this through a little bit and they'll say, hang on a second, why would I do that? Like, investing in real estate outside of an IRA already has good tax benefits. Why would I do that with my IRA or with my Roth IRA? If I want to own some stocks and some other things and also real estate, why wouldn't I just do that with my non-retirement accounts, like just the cash that I have in the bank or other investments that are taxable? And my response to that is that isn't what I'm talking about. I'm not talking about go build a retirement account and stuff it with money so that you can go buy real estate. I'm talking about there's about $30 trillion in retirement accounts, maybe 25. That's an old statistic and those have dropped. But either way, trillions of dollars, tens of trillions of dollars in retirement accounts. And those people are scared because they think their only 3 options are stocks, bonds, and cash. And those are all getting kicked in the shorts right now. This is a way to diversify. Yes, you get the tax benefits. You don't get the regular tax benefits that you get if you invest in real estate outside of an IRA, because the IRA rules overrule that. But it grows tax. You get the tax benefits of the IRA or the Roth IRA, which is tax-free. So you don't get the regular tax benefits, but you get to diversify and you get great returns in the money that's already in your retirement account. So if we're talking about that we'll call it a couple that started saving when they were young, they got $1 million, they're at 55, they're trying to retire at 63 or whatever it is, and they realize that they could take a portion of that, and most of it's in retirement accounts in this example, say they could take a portion of that, invest it in real estate, and diversify their portfolio and improve the overall returns. That's what I'm talking about. I'm not talking about do this with your IRA or put the money in the IRA first and then go buy real estate. That can have advantages, but that's some more of the nuance that I would cover in the other class. And then the last thing to expect when you have this conversation with people is this question: why is nobody talking about this? You know, it sounds like a loophole. And I've learned, so first of all, I just know enough about it that I can start talking IRS code, and that usually settles people down, but you don't have to do that. But you could tell them, like, there's a list of 3 things that you cannot buy, and it's collectibles, life insurance, and S Corp shares. But also I've just learned to, we get into these habits where we have almost scripts. When somebody asks this, I generally answer it with this, because I've learned that lands well with them. So somebody asked if this is the same thing as a REIT. I'm not talking about a REIT, by the way. I'm talking about you can own a property on 1234 Colorado Avenue, and that can be owned by your retirement account, and the tenants pay rent. Yeah. So somebody's like, this happens. This is a thing. It's not crazy. It's all over the place. Actually, there's thousands of properties across the country owned by IRAs or retirement accounts. So the way I've learned to respond to this, when people are like, how come I've never heard of that? Or like this, if they're skeptical about it, why is nobody talking about this? I've learned to answer it with this: who are you expecting to tell you about this? Because if you're expecting your financial advisor to tell you about it, don't hold your breath. They probably don't know. They've maybe heard about it, but then they've convinced themselves that it's not a good idea because it's in their best interest that it isn't a good idea. Because if a financial advisor, if I'm a financial advisor, my client takes money out of the IRA that I'm managing to go buy real estate, that's less funds that I'm charging a fee on. So financial advisors typically don't recommend this.
Hey, Brady.
Yo.
We got some questions that are pretty good. If you can if you got a minute
Yes.
to cover those, that'd be great.
Okay, so I'm glad this came up. So somebody asked, we covered the REIT. CPAs are not a good bet in the sense, like, let me say this differently. The CPAs, they will talk about this. Many of them actually don't know either. So if they do, you've got a good one that helps with this. And many of them are also worried about giving investment advice. They typically don't do that. So if you have one that will steer you in the right direction, that's good. That's a rarity. I'm not saying like 1 out of 1,000,000, but a small percentage of CPAs know that this can be done. A smaller percentage of them will put you on the right path about doing it. But they can be a good resource, but it's not generally, like, for the masses. I wouldn't say go ask your CPA about it. They'll tell you, because most won't. So what about family and friends? Like, that's just hit or miss. Depends on who your family and friends are. The answer to the question, like, is us. This is the industry where this message needs to be told. We need to understand it enough that we can talk about it confidently and get the word out so that people can add that to their planning scenario. So and it's not like anybody in real estate needs to help investors, because you don't need to do that. If your shtick is helping first-time home buyers and that's just where you focus and you don't like branching out, you refer the other business. I've never met anybody that does that, but I'm just making up this fictitious realtor in the back of my head. Like, you don't have to help investors to be a good real estate agent and serve people in other ways. But if you want to help investors, this is a really great way to separate yourself immediately and give them something that they're looking for. And it's a conversation that you can have about real estate with people, and they're going to want to have it with you. Right? Now, granted, some of them will, but I'll leave it at that. Like, it's an icebreaker that will get their attention 9 times out of 10. Any thoughts? Any ideas?
Mm-mm.
All right. Now we're going to talk about, like, rates of return. So I'm going to show the model that I use. This is something that I built with the intention of what I was talking about earlier, how to make it understandable to people who are seeing finances from their financial advisor in a way that's understandable to them.
For an hour and
And
quarter.
I'm going to mute everybody. All right. In a way that's understandable and familiar to them without overlooking the nuances, because real estate's got a few moving parts, but at the end of the day, I want to break that down to what's your value now, what's your value in 5, 10, 15, 20 years. So this is the tool that I use to do that. I'm going to just zoom in here so we can see what these variables are. This is a property that we did. It was a 3-2 townhome, $425,000. The investor put 25% down. There was nothing to improve. There was no, these two cells are for, like, if you want to finish the basement, and that was going to cost $30,000 or something, but it would increase the value of the property by $45,000. That's where we would put those details. But in this scenario, I've got another one. The next one that I show you will have those details in it. But this scenario didn't have that opportunity. It was just ready to go. And this was a busy young couple. They were both busy professionals. One was a CPA and the other is a engineer, software engineer. And they just were busy and didn't want a property they didn't want a fixer-upper. They just wanted to do something productive with some money. So at the end of the day, these are the details. This is what they collected in rent right out of the gate. I'm always projecting some amount of vacancy. There's a feature here where we can decide what to do with the extra cash flow, whether to pay off the loan with it or put it in your pocket. I'll show you what happens when we switch that later. There's the loan rate. They actually got a lower loan rate than this, but I'm trying to make it, but gosh, rates have moved so much in the last several months that this is what I did. I bumped it up a little bit so that we'd be looking at something realistic for a non-owner occupied investor. I don't know whether that rate is applicable today. That's just what I'm using to show kind of what we're going. This is not like this is what rates are today. That would be a question for my lending team. But anyway, there was no rate buy down. It was a 30-year loan. There's the taxes. There's the insurance. Because it's a townhome, the insurance is relatively low, but the HOA is higher. All things equal, well, HOAs are kind of a double-edged sword. I'll just leave it at that. The one thing, I don't mind HOAs at all as far as the expense and as far as the performance on the investment, as long as they're doing their job. The trouble with an HOA is they, in many cases, don't do their job and they don't manage the money well. But fortunately, one of the members of this couple is a CPA and she joined the board right away and she's helping manage that. So that's pretty cool. Anyway, they aren't taking responsibility for any of the utilities. That's the tenant's job. There's a budget for maintenance and capital expenses like water heaters every once in a while and stuff like that. And because it's a townhome, this is a relatively low number because you don't have to worry about the roof, the sidewalk, the landscaping, snow, nothing like that. So it's a lower number because it's a townhome. And then any, sort of some catch-all fields here in case there's other expenses. They didn't want the property managed. They were comfortable doing that themselves. So that's a no. I know that there's more to it than yes or no, but I captured the numbers on how the property management charges for that on another table right here, like what they're charging, a lease up fee, turnover, stuff like that. But I don't show that because I want to keep this particular view of it simple so that we can talk to clients in a simple way. So those are the details on the transaction. And then here are my assumptions on the property. I'm assuming a 5% annual appreciation, which I think is conservative in the Denver metro area. I'm assuming 3.5% inflation on your expenses as a landlord. So things like taxes, insurance, maintenance, repairs. What else might there be? HOA, those are all creeping up by 3.5%. And then I'm showing an annual rent increase of 4.5%, which is also conservative. It's lower than average. So you're only increasing rent by 4.5%. And this is a weird variable, but what I do with this is I do a comparison rate. So let's look at this graph. This top graph here is your money, right? You start with 114,000. That's the initial investment. This is the growth of that. The dark blue is the cash you put in your pocket. The green is the value of the equity going forward. And this blue line is the combination of the two. I know it might seem like that's not necessary because it sits on top of this, but sometimes in negative cash flow situations, this blue line here sinks below the value of the equity because the total value of the investment is the equity that you've got minus the cash that you've had to spend to keep it. So this blue line would fall below. I'll show you an example of that in a minute. Okay, so Deanna had a question about inflation. I'm going to tinker with some of these variables in a second. I just want to go over the format here and then I'll tinker with that one. So this orange line is a hypothetical rate of return on this money. So if I'd invested this money and got this annualized rate of return, which is 10%. Now we can change this. So if we want to see what if it's 8, then that will change this orange line. So we can put it at whatever we want. I like to keep it at 10 because I don't like trying to cherry pick real estate or like create a straw man out of the other investments people have. If you're a good investor and you're disciplined and you don't panic and you don't get elated when things go up, you just steady and you do what you're supposed to do, 10% is reasonable. That's doable. So you start here. If you're earning 10% on this 114, that's that orange line. This blue line is the value of your real estate between the cash you put in your pocket and the equity that you own because you own the property. And on the right side here, I show cap rate. I'm hesitant about that because cap rate is in my experience, cap rate is more of a misleading figure than it is helpful for new investors. They don't know what it means. Cap rate is simply the net operating income as a percentage of the value of the property. It doesn't include any leverage. It doesn't include any growth. It doesn't include any equity appreciation expectations, anything like that. But because it's expressed as a percentage, and that percentage is in a range where people think of their money earning, at least it's in the range, they just take a mental shortcut and think, oh, 6% rate of return in real estate, that sounds reasonable, whatever. But it isn't that at all. So I hesitate. I do versions of this calculator where I just eliminate that because it raises more questions than it answers. But this version has it in there. So there it is. And then below, you'll see just some snapshots. So by year 5, our net monthly rental income, including the cost of maintenance. So by the way, the cash flow on this is about $167 a month, but I'm recommending, hey, you're going to have expenses down the road. It'd be smart to save $125. And that's what I'm going to project going forward. Whether you actually do that or not is up to you. But when a water heater is repaired and you've been taking the money and investing it somewhere else, you're going to have to take that money out and repair the water heater. And I'm just going to take it out of the cash flow when I project this. That's the most conservative way to do it. I'm assuming that you're saving it, even though they probably aren't. Not because they're not good at it, because I wouldn't either. I would have a slush fund, and then every extra dollar of cash flow, I'd go reinvest it somewhere else. But I do want to account for it because when we look over a 20-year period of time or something, we have to assume that there's going to be some expenses every once in a while that add up to an average of $1,500 a month or $1,500 a year or $125 a month, and that number is increasing with inflation. It's creeping up over time. So that's, I guess I'm saying that to give you some comfort that I've included all of the variables. I'm not cherry picking I'm not touting real estate in a way that isn't reasonable. And by year 5, our net monthly income is $632 a month. We now have $245,000 of equity. We've put $17,000 of money in our pocket by that time because of the positive cash flow. And the equity plus the cash we put in our pocket totals $262,000. Now we have something useful. We have a time frame. We have a beginning value. We have an ending value that allows us to calculate an annualized rate of return, which in this case is 18.09%. Now, again, this is still more complicated than what they see in most financial advisors' office, but I think it's something that they can digest. This is the return. This is what it would do if that same amount of money earned 10%, and the return is made up of these two components. That's the overall investment value. Then, of course, we've got this income. People want to know what's the monthly income. And this is including maintenance reserves. So they're making about 167, but I'm subtracting 125 of that for expenses. Now they come at I don't want to say random, but irregular times and amounts, but I'm taking it all out as we go because that's a conservative way to illustrate it. So we're about neutral when it starts. I mean, we're a couple $100 ahead, but neutral as an investment projection because of these expenses. But look what happens if we decide, hey, with every extra dollar of cash flow, rather than reinvesting it somewhere else, I want to pay it against this 7% loan. I want to build the equity up. Or maybe I buy it when I'm 55 and I'm not trying to grow my real estate empire. I want to get it to maximum cash flow as soon as possible, which is a zero loan scenario. I want to pay the loan off. I switch this to yes, and without putting any extra money any extra of my money into it out of the gate, or just use the extra cash flow that it generates itself, that loan gets paid off in 15 years. And by then my cash flow is $4,100 a month. That's an exciting number to look at, right? Within 15 years, this property pays itself off with the tenants. You don't have to put extra money into it, and you're cash flowing $4,100 a month. a tax-friendly $4,100 a month, almost 42. On top of that, you probably have refinanced by then. If not, we'll talk about that because if not, you actually avoided you avoided a disaster if you're still paying a 7% rate and you're happy with that, right? If rates haven't gone down, we'll talk about that in a minute. But there's one other thing I was going to mention here. I don't remember. Oh, it was, let's go back to the scenario where we were talking about $100,000 becoming 400 and whatever at the financial advisor's office. This 114, this is the number that everybody's focused on, and it's not unimportant. $167 a month. That doesn't feel that exciting with $114,000. You could get better income from a bond fund or gosh, maybe even a stock portfolio paying dividends. But you have to remember that this cash is paying itself off and this income is increasing and you've got this massive amount of equity. So look at your wealth in 20 years on this property alone. You've got $1.42 million, 1.43. This is how much of that is the equity, 1.15. The cash is meaningful. I don't want to ignore that, but it's a third roughly of that number or of the total. Oh gosh, even less than that, quarter, something like that. So it's not unimportant, but I think people put too much weight on it. So this investment pays itself off in 15 years. Now they don't all do that, by the way, but this one isn't particularly unusual. This is a decent property. It's not the best one I've seen, but it's a common scenario. Okay, let's tinker with. I'm emailing the spreadsheet out, by the way, Rich. I'm going to give everybody I give this away now. So it took me a while to get it compliance and to lock things down that I don't want people making a mistake of putting. It's a long story. It's hard to build these in a way that I can give it to you that you can use, but I've worked on that a lot over the past month, and it's now in a state where I can give it to you. So if you guys want, I'm going to be emailing the spreadsheet out, and if you like tinkering with numbers yourself, you'll have a copy of this.
Hey, Brady.
Yeah.
I would suggest, and correct me if I'm wrong, I would suggest everybody sort of make some mock scenarios up. And, when you're playing with this thing, and correct me if I'm wrong, but I mean, putting just, hypothetical entries in this thing and just to understand what the yields are. I wouldn't first out of the box go send it to some investor without knowing what all the boxes mean.
Yeah, definitely. What I was thinking of doing, this isn't on my calendar, but I guess we can just do it by a thumbs up with the vids. Would it be helpful to have a class where I show you what's going on behind the scenes so that you know how to use it, like a training, like here's why you might expect to see this, here's why I don't put that in there because it happens in another thing, or this is how I explain this. Okay, would you guys want to do that if we did that? Okay, enough of you, I think, are doing that we can, and that I can't make that CE, but we can just go through this so that you know how to use that tool. It's acting weird right now because of the Zoom, but it works. It's a good, reliable piece of software here. Anyway, so I'm going to tinker. I've got a question here I want to address where somebody asked, can you commingle funds? Can you buy an investment with part IRA and part yourself? And the answer is yes. It's tricky. And you, like when expenses are due, you have to pay those at the same ratio of ownership. So if you're 50-50, yourself as a human with a pulse, and then your IRA as its own entity, if there's $1,000 bill that comes due for that property, maybe some maintenance that was done, you have to pay half that bill as yourself, half that bill as the IRA. Now, this sounds complicated, and I guess ultimately it kind of is, but the custodians do all of that for you. And they charge it's like a couple $100 a year to have a custodian do this and report to the IRA or the IRS what they need about this IRA so that you can compliantly invest in real estate. But don't let it bog you down. You don't need to understand all the nuances right out of the gate, because as soon as you get involved with a custodian that knows what they're doing, like First Direction or New Directions Trust Company is the company that I recommend. They're a big national company, but they're based out of Colorado in Louisville. And they're great. They have like tens of thousands of accounts. They're really, really good at this. And they make it really hard to not comply with what the IRS requires. So if there is a bill, if you own the property half and half, and there's a bill that comes due, they're going to be the ones that collect that bill. They're going to be the ones that confirm with you, hey, we're about to pay this bill. Here it goes, like you do next to I don't want to say next to nothing, because you're ultimately you make the decisions, but they make it so easy so that all the books and records are kept so that it's compliant. Not only is it compliant with the IRS, it's really nice for you to have those records so that if somebody says, did you make money on that property? You can say, yes, I made exactly this amount of money because I have the records. It's really helpful. Okay. Yeah, New Directions Trust Company. I'll write it here in the chat. Somebody asked for that information. Come on, keyboard, here we go. I believe this is their website. If not, you can Google them. They'll come up. I think that's their website. Okay, let's tinker with some of these numbers. I find this absolutely fascinating because it teaches you a lot about what moves the needle more than others. For example, here's a couple. Well, let's deal with inflation. So Deanna asked, what number did you want to see in there? 6.2. Let's put 6.2. Now that is in and of itself, that's going to be a bad thing for your returns. Let's keep an eye on this number, for example. Over a 10-year period of time, if we're accurate with these projections, and we have a 16.22% rate of return in 10 years, what if inflation is actually 6.2, and this is affecting our expenses? Now our rate of return is 15.86. I have to think about why that's happening, but anyway. But here's what I'm gonna mention about that. That is that your inflation is not in a vacuum. If inflation is high, so the inflation is measured with an index that they call the CPI, Consumer Price Index, and rent is 32% of that index. It's the largest portion of that index by a huge margin. It's 32%. The next two components are transportation and energy, and those two components together aren't as big as rent. They call it shelter in the CPI, but it's rents across the country. Even if you own a house, they run an equation that says what would it cost you to rent that same place. So that shelter piece of the equation is rent. And if inflation is going up, then rent is going up. It's all a part of the same. I think of it like inflation is bread and rent is the flour. They're not the same thing, but it's the largest and most important ingredient in the bread. So I can't imagine a scenario. Those two statistics, rent value or rent increases and inflation, are 100% correlated. And you can go through Fred. That's a really cool. If any data geeks in there, if you go to the Fred website, it stands for the Federal Reserve Economic Data. It's a Federal Reserve site where you can look up all sorts of really cool data. But if you look up inflation and rent, like you see those things bounce, they're the same thing. It's the flour and the bread. The cost of the flour and the cost of the bread are going to be heavily correlated. So if we have inflation of 6.2%, I'm guessing that appreciation, because that's also a part of inflation, appreciation is going to be something, it's always long-term. As far as trends are concerned, appreciation on real estate is always higher than inflation, and rent is always something very close to inflation. So now we have rent increase going up faster than usual, which is good if you're an investor. Your expenses are going up faster than usual, which is bad as an investor, but you're also getting better appreciation because those things move together, especially if we're talking about long trends. They might not move together in any given month because that's too short a time to get a trend, but over time they are 100% correlated. And now we're looking at a 20% rate of return. Like that is actually a good thing. And I think we sort of intuit that already, right? If inflation happens worse than we expect, what asset do you want to hold, right? Real estate, because inflation affects the rent that they're paying and it affects the value of the home. That's the perfect thing to do with your money if you're worried about inflation. Thoughts or questions? I'm gonna show another example. Keeping an eye on the time. I want to wrap up in about 10 or 15. And then I want to talk a little about marketing. If anybody wants to stick around, I've got some ideas on how to get the word out, but I don't want to mingle that with the CE stuff. I want to chat about this. So I'm going to go into another example. Everybody on board? Everybody with me? All right. Let me get, I pull this other. example. For the sake of time, I had a couple examples set up. I'm going to skip one of them to show this one. I love this one because this is a really fun thing to sell. Cheers or a shout out to Monica Graves, who is in mountain communities. She specializes in this sort of thing, but I love this topic. This looks a little weird. In fact, let's take a look at this. Remember when I said that this blue line isn't always on top of the blue and the green, this blue line here? That's because this is your equity, but this is the cash you've pocketed, and it's a negative number. It's cost you money. This is a negative cash flow situation property. So the owner bought it, and it's costing them money to keep it. That's why this cash is below. So the blue line is the total value of your investment. The green is the equity, but it's cost you some cash. So hopefully that looks a little weird, but that's why that's happening. But here's what's interesting. This is an investment that if I was never going to go there, if I had no interest other than its investment viability, probably wouldn't buy it. But this is what it looks like when you invest in these mountain communities, because it's really tough to cash flow in a place. This was a townhome in Fraser, by the way. Really tough to cash flow in these kinds of places unless you're putting like 50% down and you make your mortgage very, very small. Or you could obviously buy it for cash and then you'd have cash flow. But this is an example where some friends of mine bought a house in Fraser. They bought it for $850,000. They put 25% down. There was nothing to improve. It was in good shape. There were some closing fees. They got so this is what they're getting after their expenses. So when I do short-term rentals, I take a couple of shortcuts. This is something we'd have to talk about in that class. I put rent occupancy at 100 because when you use AirDNA, they're already subtracting occupancy out of their estimates of what you're getting. So because that's already been accounted for, I just show 100% occupancy. Like this, if we get $3,600 a month out of this property, that is all of the money that we're getting. We don't have to subtract that again because it's already been diminished due to some vacancy. But in this property, they're expecting to get about $3,600 a month on average. And let's see, that's the loan rate they got. They got it as a second home, so they got better rates. That's changing, but that's what happened for them. And there's the taxes, there's the insurance, there's the HOA. I suspect it's a little higher than that now. Those have all increased, it seems, up there. There's their utilities. There's some maintenance and expenses all budgeted in. And I remember, so they sort of shocked me when I talked to them about this. Now, these are friends of mine, but they asked to run a quick scenario because they wanted to buy a property because they like to ski and they want to make that a part of their lives with their girls. They have two young, adorable little children. And so I said, all right, but just so you know, I hadn't put the numbers in yet. And I said, just so you know, it's probably not going to cash flow in a place like that. And they're not new to real estate. They're like, yeah, we understand that. So let's move forward. We still want to take a look. So we did it. And when the numbers came out, I was like, ooh, that's going to sting. $1,200 a month negative cash flow. Like, I don't think they're going to like that. And I just sort of kind of braced for their disappointment. And the wife turned to her husband and said, well, honey, we were just talking about adding $2,000 a month to our 401k. Why don't we just do this instead? Because here's the thing. So negative cash flow, it scares a lot of investors. And I could see that, like you're committing to a payment there. And I don't want to gloss over this or pretend like it's the same as putting money into a 401k, because there's a slight difference. And the difference is, if you want to stop putting money in your 401k next month, you just stop putting money in your 401k. If you want to stop putting money into this next month, you have some work to do, right? You got to sell the place or something like that. So it isn't exactly the same, but they could afford that easily, and they wanted that place. But here's the bottom line. I'm gonna move over to this side of the graph. Take a look at this. Yes, by year 5, they're still cash flow negative, right? They're still below the number. But they also have $492,000 of equity, and they have spent, or like they are negative cash flow over those 5 years, $80,000. Now that sounds like a lot of money, but it's essentially, it's $1,000 a month in the first year, a little bit less than that in the second year on a monthly basis. So if you subtract from their equity that they then have, if you subtract from that the cash flow that they've spent to keep that property, they're still getting a 12.8% return on the money they've invested, including the cash that they put in. That it's cost them. So that's a negative number on that rate of return. So it's bringing the return down. That is their overall rate of return on the money they put in, the money they put down, and the money they've been putting into it all along the way. This blows my mind, because what I've noticed is that in this kind of market, this is something people want to buy. It's almost like they just need permission to do it. And this is like saying, yeah, that place that you can't go skiing and stay in your stock portfolio, but you can go do that with this investment that's also earning something that you would hope to get out of your stock portfolio at the end of the day anyway. So it's a little different than the one we looked at last, which was just purely an investment. And I'm using really conservative numbers. Now, mountain properties are weird, because if Denver takes a hit, well, I can't even say that. It's just not so correlated. But when they take hits hard. Like if there's a few bad seasons and there's no snow, that affects that market. If there's a couple of great seasons, that affects that market. But 5% appreciation is pretty conservative for that kind of market. Anyway, I won't go into any more to tinker with these, because we saw how all that stuff moves it. But I just wanted to show that particular example, because I love, not only do I love that because it opens people's eyes to that. You're talking about, it's one thing to help somebody sort of improve their investment position by diversifying and getting something with a great return and some cool tax benefits. But it's another thing when you do something like this, because not only are you doing that for them, you're impacting their life in a way that touches them immediately in a way that improving their investments doesn't, right? It's so much more of an emotional transaction and what's the word, development for them. So it's really fun to do these kinds of properties with that kind of idea, that kind of investor. There's another thing I want to show. Anybody here property managers? Anybody here? Any property managers in here? Or deal with that? Okay. Maybe I'll skip that then. We'll gloss over that. Bottom line is that property management doesn't cost nearly what people think it costs, right? I'll do an abbreviated version of what I was going to say. If property management, the new Windows, got to get used to it. All right. So in this, let's say this is that townhome that we did the first time. If property management, let's say in this example, I have it set at 9% per year plus a 50% lease up fee and turnover on average every 3 years. And we can always tinker with that to calculate the cost of management. But if I go to yes, before I click this, let's take a look at this return. So let's look at a 10-year return. If my 10-year return based on these assumptions is going to be 20.43%, and I decide to hire management. Now, when people think, okay, management's going to cost 10%, people just don't do the math in their head. They don't think it through, because it's actually it's more complicated than what we're going to do in our heads naturally anyway, any of us. But it's easy for me to think if management costs 9 or 10%, in this example, I have 9 in there, but if management costs 9% and I'm expecting 20, I'm giving up roughly half of my returns when that happens. Now, we all know that that isn't the way it works, because most of the returns come from the equity anyways, and the management doesn't get to touch any of that. It's just the cash flow. They get 10% of the cash flow. So how much does that change your overall return over a 10-year period of time? The answer, it went from 20, I forgot what it was 20 something, 20 point something down to 19.33, 20.43 down to 19.3. It cost them about 1% on their return over a 10-year period. I'll move this back to cost them 1% over a 10-year period for putting all the headaches on somebody's shoulders. So whether or not, so this comes in handy when selling the idea of real estate investment in general, because one of people's big hangups, and this is understandable, is it seems complicated. I don't want to evict people. I don't want to answer the phone. I don't want to go through rental applications. I don't want to get a call at 2 because there's a water leak. Actually, I probably would want that call just to make sure that my manager on top of it also. But that it's an intimidating thing to become a real estate investor, and you can show them like it costs you like, okay, so what if we strive for a 19% rate of return? Is that acceptable? Yes. Well, that includes management. You can get a 19% rate of return and have a manager take all the phone calls, given these assumptions. Oh, I still have the higher ones from inflation in there. But either way, like management just doesn't cost what people think it does, because they're not putting the percentages in the right place when they're doing the math in their head. They're making inaccurate assumptions about that. Make sure. Yep. The answer to that is yes, by the way, Juliana. That was just a private message. She sent me something earlier. I want to make sure she knew I got it. Okay. I'm going to skip these examples. This was the example I wanted to talk about in the mountains. I was just going to do a bigger example on a fourplex. And maybe we can do that at the end if you want to stick around and see it. I just want to be respectful of your time and the CE requirements. Okay, one thing that I want to mention is about timing. So this is the interest rate conversation. Kevin talked a little bit about it, like what we're expecting going forward. I have a different message about it. Not that I disagree with him, but it's just another way, sort of depending on who you're talking to and depending on your style, you can pick and choose what's right for you, plus what you do on your own. Like you guys have been in the industry longer than I have. So, take what you can from him and me and make it your own and do what you want with it. But this is the conversation that I have about interest rates with people. I already mentioned that it would like gasoline, which I think is helpful. Like I would never not invest in real estate if interest rates were 8%, if the numbers made sense. Like, I don't care that they're 8%. That's gasoline in my truck. I want it. I need it. It's valuable. And the bank's going to buy most of my property for me. Like we get focused on what we can see, right? And that's a human thing. And we all do it in areas that we're not experts. So it's easier for us to see that we're doing it in real estate because we're dealing with this all the time, but we do it in other fields. And so we have to give people, some grace for that. But here's my conversation about it. Whatever the rates are today, one of two things can happen. They can go up. How are you going to feel if you get a 6.5% mortgage today and a year from now, rates are 8%? Like that's going to be your emotion. Yeah, exactly. You're going to be like, I'm so glad that I got a 6.5% mortgage. I'm going to talk a little bit about this because there's more to it than just that, but that's the obvious advantage. I got 6.5, rates went up. Whew, I'm glad I did something. If rates go down, so if you got a 6.5% mortgage and rates are 5% in a year or whenever, is the emotion the opposite of that? Like, are you kicking yourself because you have a 6.5% mortgage on a property and rates are at 5.5? No, it's like the easiest thing to do. Like we're chasing people to refinance. All you have to do is answer the call. You don't even have to do much, right? You just restructure the debt, lower your payments, move on. And then your cash flow increases when that happens. So it's like only one of those rates can only go in those two directions. And this one is good news for reasons I'm going to explain, not just the obvious one. This is good news that you got what you got. This one's good news because you can lower your expenses. And it probably increased the value of your property because affordability just went up. But let's talk about when rates go up. There's the obvious advantage. You locked in a lower rate. But think about what happened. When rates go up, the reason rates go up is because ultimately the feds are trying to control inflation. They don't control mortgage rates directly, but mortgage rates are sensitive to the Fed fund rate eventually, right? The trends go in the same direction. So if the feds raise rates, the reason they're doing that is because inflation is out of control. What is going on if inflation is out of control? Rent is going up. So if you got a 6.5% mortgage today and rates are 8% a year from now, the rental market for your property is skyrocketing because inflation's out of control. That's why rates are going up, because the feds are trying to keep that from happening any faster. And we already talked about shelter being 32% of that. So that's a long-term, that's a super high correlation. If rates go up, not only that's kind of what we did in that one example where we kicked up the inflation and the appreciation and the rent, because all three of those things are happening together. So if rates go up and you have a 6.5, that's good news. And then when rates go down, I don't need to tell you guys, we're all in the industry. This is just something that I would do for for the public real quick. Like if you refinance, you got all sorts of options. That's our team. We have, I'm not going to talk too much about that, but we all have different roles. We do really well. I'm the one that always looks confused. I'm that guy. Like, what are we doing? He's the one they recruited from Germany and he barely speaks English. So he doesn't know what's going on. That's a dumb joke. I'm assuming you guys are laughing because that was freaking hilarious. But here's my offer. I do this. I have this this YouTube channel where I put all of these concepts and others about investing, about renting versus owning, some of the math behind that. A lot of these concepts are broken down into 3 to 5 minute chunks that you can share if you are having a conversation with someone and you can think of, hey, this can be explained with these visuals. These are links that you can take and send to people in very short increments. At the end of each one of these videos, I simply say, connect with your realtor to apply these concepts. I'm always referring back to the realtor. I don't want them to call me because they watched the video. I want them to call the person that shared the video with them. So I encourage them to do that at the end of all of those videos. I'm going to throw the URL in there in case you don't want to use. I'm going to throw it in the chat, by the way. So here's the URL for that. And then lastly, this is how I keep a record for CE credit. If you attended, if your camera was on, I saw everybody's was on except for maybe one or two. But if your camera was on, and if you listened to the full hour and 40 minutes, because it requires 50 minutes for each CE credit hour, I'm going to put this link also in the chat. This is how I keep a record of who attended, because I get 3 or 4 phone calls a year from DORA auditors that are auditing you guys, and they'll say, "Did this person show up? Did they get the CE credit?" This is the link for that correlates with this QR code. Just go in there and put your name, information, your license, and then we'll get out a CE certificate in the mail later today, in an email, excuse me. And that's just how I keep a record, so that when they can call, I can say, "Yep, that person was here," or "Nope, somebody's lying to you. I don't have a record of that." This is the record that I keep of that.
Hey, Brady.
Yeah.
I got punted off a couple of times, so I was a couple minutes to get back in. It took me a
That's
couple.
fine. That's
Okay,
fine.
yeah, I just
Like it's an honor system. Like if you,
Yeah.
I can't like look at the cameras the whole time that I'm doing this anyway. So if you have, like, if you were here for the hour and 40 minutes, if you got what we were talking about and you participated, then, you know, just confirm that you did that in that form. The last question in that form is whether or not you want content from us. So we have something going out today, actually, which is the next webinar that we're doing for first-time home buyers, where we show the math behind renting versus owning. So you'll get things like that. You'll get videos when they're new on YouTube. I make little announcements about that. Any content that we put together, when I update the calendar, I'll be not the calendar, excuse me, the calculator. I've got some updates already in the works that I'm changing the calculator slightly. When that is new, I send that out to the list. So if you want that stuff, you can always unsubscribe. But if you want that stuff, answer that last question yes. If you don't want it, say no. I'm a big believer in I don't market to people that don't ask to be marketed to, because I don't like that when people do it to me. I only want to connect with people that found this interesting. I don't want to pester people that are not interested. So that's what that form is. That's how I keep track, and that's also where you let me know, do you want content from us? Okay. That is the conclusion of the CE. I want to talk marketing a little bit and just get some feedback here. But feel like if you need to bail now, I totally understand. That's great. Well, it's not great because this is going to blow your minds. But no, I'm kidding. If you need to go, or if you've had enough, you decided it's not for you, feel free to go. That we're gonna.
I just wanted to say thank you. Appreciate your time. Thank you very much.
You're welcome. Thanks, Tyson. Okay, so getting the word out. I'm going to let's see. I'm gonna talk about what we're doing, and then I'm gonna talk about what we're building that isn't available yet. But essentially, if there's anybody that you can think of that needs to hear the kinds of messages that we talked about today, this is what we're currently doing, and I'll talk about what we're about to do. And I think of it this way. So I had this mentor in my financial career that he and I are still good friends, but he said something that I'll always remember. He says there's two kinds of sales. There's uphill sales and there's downhill sales. And by that, I do not mean one is easy and one is hard, or one is hard and one is easy. It's not like that at all, because we always have competitors. We need to be the person that they call when they need help with real estate or whatever it is you're selling if you're in sales. So, but the difference between uphill sales and downhill sales are the position and the psychology of the person we're selling to. So an uphill sale, in my example, is something like insurance. And the example that I give is if a friendly insurance agent that I would totally have a beer with anytime, if a friendly insurance agent that isn't my agent, but they called me and said, "Hey, Brady, you know, I do insurance. Let's go show me your deck page. And I bet I can save you. You know, my clients save on average $280 a year," or something like that. I would say, "You know, Jim, I'd rather overpay. I really don't want to deal with that. I like what I've got. I trust my guy. I'm not interested in dealing with my insurance right now. That's something I'm only going to address when I have a problem. I know that I need it. I want it. I like that I have insurance. That gives me tremendous peace of mind. However, I don't want to deal with it. Once I've got that set up, I want to go back to the things that excite me. And if insurance excites you, you're a weirdo." Next is the downhill sales. That was a joke, hopefully. I mean, that is true about me, but maybe you do like insurance. How about it? It's 2023, right? Okay, a downhill sale is like the shiny objects, right? These are the things that people, so like insurance, I want to have, but I don't want to buy. The downhill sales are things that I want to have and I want to buy them. Buying them is a fun process. And real estate is somewhere in between those, or rather it's both. That's probably a better way to say it. There's uphill parts that people don't like doing. And I think the classic example of that in a real estate transaction is the underwriting. Like getting underwritten is like doing your taxes. We can make it as painless as possible and as frictionless as possible, but it sucks. Nobody wakes up in the morning thinking, I want to submit my stuff to an underwriter today. That's not fun. That's kind of the uphill portion. The downhill portion is when, in an investment sense, like if we're talking about a family moving in, when they start talking about the color that room is going to be and where this toy is going to go in the backyard or whatever, or where the tools are going, where the workbench is going to go in the garage, that's they're enjoying themselves, and that's really fun to be a part of. So we want that to stick in their minds, right? In an investment sense, when we start running these projections and we start looking at homes and areas and rental comps, that gives them a similar feeling of excitement. It's kind of a rush. And so what I want to do, what my job is on our team, is to take over as much of that uphill portion of the sales process as possible. Now, I oversimplify it because not all of what the realtor does is downhill. There's some uphill components of that as well. And there's some downhill components to what I do. But in general, the paperwork is the uphill. The property itself, the three-dimensional experience is the downhill. And my job is to make that as easy as possible. So the way we currently do that is I do webinars. We do about 3 a month on different topics. And the ones I've been doing recently have been showing the numbers between, what it's really costing you to rent, not just the money that you're spending, but how that compounds over time and how every year makes hundreds of thousands of dollars of difference in your life in the future, stuff like that. So I do webinars about that. I haven't done one with this content about investors yet because I've been building out the platforms to do that on the renting versus owning. But now that I've built that out, it would take me a short time to convert this. And I'm legitimately asking you, if we did a webinar about the content that you saw today, maybe a little bit shorter, definitely shorter, cutting out the things that we would talk about as professionals in the industry, but just focusing on a client-facing presentation about investing. Is that something that you think would help take over a chunk of that uphill sales process? And if so, I'll build it. It's the same content. I'll organize it and then I'll put it on a platform where we can deliver it to the public, and I'll give you marketing content that you can use to get, and registration links and stuff like that. But I don't want to go through that process. Not that I'm lazy, but there aren't enough hours in the day to do what I want to do. But if that's something that you think people would use and you could get people to, okay, actually, let's do this. I've seen a bunch of yeses in the chat. Put no in there if you think that isn't what you would want, because I want to know that. And it's not offensive, by the way. I want to be efficient with my time. And the way we do these webinars, by the way, so this is what we do for the renting versus owning ones. I provide you all sorts of marketing material, not because I think you're going to use all of it, but because everybody uses different things depending on how you reach your circles. So I'll give you like scripts for emails. And I expect when you get those that you'll probably change them so that they're, they sound more like you. But I just kind of help get the words flowing. So I send scripts, I send flyers, I send images that are pre-designed so that they'll fit on Facebook's requirements and Instagram's requirements. So I provide content that you can use to get people's attention. And then when they register, they have to put the name of the agent that gave them the link in the register. They can't register without putting your name in there. So they put the agent's name in there, and that automatically delineates in our database so that we make sure that we don't cross-contaminate the people that show up. I agree with you, Rich. Doing something live and in person would also be, I'm open to doing both, but yeah, I have so many ideas. It's fun to do this stuff. But bottom line is I give you a bunch of marketing material. I let you know when it's happening. I say, if you want to post it on Instagram, Facebook, send out emails, however you connect with your people, here are some things to help do that. If you can think of another object or another item that I could give you that would help do that, then I'm open for it. Those are just the ones that come to mind. Scripts for emails or letters or posts, images for Facebook and Instagram, links, and a flyer. And then in that webinar, we know if you sent somebody, we know that those people belong to you as leads. And so after the webinar, we don't follow up with the lead, we follow up with the agent. We're doing this for you guys. So all Also, in that webinar, we ask for referrals. We say, who else do you know that needs to hear this message? And if Rich, everybody's heard you talk, we know you're on, or this is a meeting. Sometimes I'm doing webinars and people don't know who's on. But Rich, like if you sent somebody and they attended and they're like, my brother needs to see this. And so he provides his brother's contact name or contact information and name. My call isn't to the brother. My call is to you, Rich, saying, hey, your client that you sent, he said his brother also needs to hear this message. Do you know this guy? Do you want to follow up? Do you want us to follow up together? We have some default ways that we generally follow up if you don't have a preference, but we strategize with the agent on how to get that referral's attention from the client that showed up at the webinar. So I'm like, we want referrals as much as you guys do. And I just script in the ask. So in those presentations, I ask, hey, this is cool, right? This is awesome, right? Who do you know that needs to hear this message? And that referral is also your client if it's your client that brought